Alrighty. So in this video, I'm going to share with you what I call the unlimited income option trading strategy. Basically, it's a way for us to extract extrinsic value every day, right? What we want to do as premium sellers is to try and get as much of the premium which we have collected upfront, and we use Theta Decay to advantage. So the objective of this strategy is to continuously extract extrinsic value from the market all the time, and for this, we're going to use Theta Decays, right? As premium sellers, we want to use Theta Decay to our advantage, and ideally what we want is to have trades on at least 80 to 90% of the time. So that means we always want to have some sort of position in the market. This way we're always taking advantage of time decay, always extracting extrinsic value. And for this purpose, the product which we want to choose would be index ETFs as opposed to individual stocks, right? Because with individual stocks, you're going to be very volatile, because you're going to be exposed to earnings, right? If there's earnings, the market can gap up or gap down, which is not what we want as premium sellers, because ideally we do not want the market to move that much, because we're going to be using strategies like iron condor and credit spreads, right? So index ETFs also do not have what we call unsystematic risk, where the company will release news where it will only affect the company's stock price. Like for example, if a certain product of the company has been recalled because of bad reviews or some faulty mechanics, right, that's going to affect the stock price. There's going to be a gap down, right, if the market perceive it very badly, and it's going to be bad for our strategy. Or if, let's say for example, Disney just released the recent movie and it didn't do as well in the box office as they had expected, and again this would affect the price of the stock. So that's not what we want. So we want index ETFs for our purpose, right? So the option trading strategies that we're going to use is three of them. All right, we're going to use the iron condor, which is a market neutral strategy. If you don't know what the iron condor is, I've already created a video dedicated to the iron condor. You can go ahead and watch that first. I'll put the link at the top right hand corner of this video. Next, we have the bull put spread, also known as the short put spread, and the bear call spread, also known as the short call spread. This too is what you call credit spreads. Again, I've created a video on this. If you're not sure about this, go ahead and watch the video about it first. You can just go ahead to my channel and just Google for this credit spreads, and you see a number of videos that I've already created on this. Alright, next we're going to talk about the strategy. So ideally, what we want to do is we want to start out with a market neutral strategy, which is the iron condor, right? So for example, we want to see the market moving like this, and then somewhere at this point, right, where it's in between this previous swing, we're going to initiate a iron condor. Ideally, we want the short strike to be above the previous swing high, and the short strike of the put side to be below the previous swing low. Now, sometimes you may not get it, sometimes you can. So it really comes down to how well you plan your iron condor, right? So in this case, for this iron condor, what we want is to have the short legs, right, ideally to be above and below a previous swing high and low. And then we have the long leg, right? This will be served as an insurance in case the market somehow just shoots through the roof, right? Let's say if it goes to the moon, this way we know that we're not going to lose a lot of money, because we already have limited our risk to the spread of this width of the iron condor, right? So next, what we want to take a look at is the stochastic, right? If you're not sure what the stochastic oscillator is, it's basically just an indicator to tell you whether the market is overbought or oversold, right? It just gives you an indication to tell you, hey, maybe the market is a little bit overbought, you might want to go for a bearish trade, or if it's oversold, you might want to go for a bullish trade. So that's what we're going to be using for this strategy. So since the stochastic oscillator indicates the overbought oversold regions, we do not want to initiate an iron condor when it's overbought oversold, but rather when it's somewhere in the middle, which is around the 40 to 60 range, which I'm going to show you later on the chart. Right, next we want to see whether the price is in between the previous swing high and low, which I've talked about already down here. Now, so what happens if the market actually breaches more of the side? So in this case, let's say it breaches the short strike of our iron condor on the call side. So in this case, what we want to do is we want to look for bearish trades right now. And the way we look for bearish trades is to initiate the bear call spread, right? So we want to see whether the stochastic is overbought at this point. If it's overbought, then what we want to do is to place our bear call spread. We want to initiate a bear call spread. Ideally, we want the short strike to always be above the market, right? We want the short strike to be out of the money, and then we buy the long leg, which is further out of the money. So this way we have some room to be wrong, you know, because the market could just go up a little bit and then let's say for example it comes back down. This way we can still profit. So this is the ideal situation, because it could even come back down to below the short strike of our iron condor as well. So this way we can profit on both these strategies. Now sometimes you will find that it could just blow right through, which is fine because we have our risk limited. We are playing with probabilities here, but in the long run you're going to find that most of it could come back down and then you're going to profit on both of them. Alright, so this is if it breaches the call side. Now what if it breaches the put side? Well, it's just the opposite. Basically what we're looking for is for the stochastics to be oversold. So let's say it comes down here and the stochastics is oversold. This is where we want to look to put on a bull put spread. Alright, so let's take a look at the chart to have a better understanding of what I mean. So this is the chart of the Russell 2000 ETF, which is the IWM. So as mentioned earlier, we really want to go for index ETFs. So that means the big four. You have the diamonds, you have the spiders, you have IWM, and you have QQQs. Any one of these would do fine. Now, the next thing I'll do when I open up the chart for the index ETF is I will start to draw these lines down here. You can see these are levels. So it just gives me a very nice, you know, round number to tell me where I want to initiate the strategies, right? So you can do this if you want to. If you don't want to, that's fine as well. So I like to do this is because I only want to look for trades once it touches any of these lines, right? So let's say for example I'm looking for a bullish trade right now. Let's say you can see that right now down here it's oversold. So if it's oversold, we're looking for bullish trades, which is the bull put spread, right? So in this case, I won't look for a bull put spread yet. Basically what I'll do is I'll wait until it touches one of these lines. If it touches this line, then I'll take a look and see, hey, is this can I, you know, place a bull put spread which is below this previous swing low, all right, previous support area. So what I'm looking at is 160. So at 160, I'll try and take a look at the option chain to see if I put a short strike at 160, am I able to get a good credit, right? And then I have the spread maybe 5-point wide or 10-point wide. So ideally we want roughly around 30% of a 5-point wide spread, right? That's around $1.50, and $3 of a 10-point wide spread. Again, 30% of the width of this credit spread. So if it comes down to 170, then I'll start looking at the spread. If it's down here at the moment, I know there's nothing for me to do, right? I'm not going to place a short put spread right now. Now, if you're aggressive, you want to, you can go ahead and do that. I like to wait until it goes lower, and if it comes down here and I cannot get a good credit here, let's say for example I only get $1 out of you know, the 5-point wide spread, then I'll say I will pass. So the next time where I will look at this spread again is when the market goes even lower to 165. Only at 165, then I will start looking at the credit spread, at the bull put spread. If it goes somewhere 167.5, I'll probably not initiate it. Again, this is my choice. It's up to you, right? So this is what I'll do. I'll draw these lines down here. Now, these lines, the spread width down here, you can see either way I choose 5 points, but for the spiders it will be much wider because the spiders move bigger, right? It's more volatile. So I'll go for a wider level. There will be 10 points wide. I'll go for every 10 points wide. So this way if it goes to every 10 points, then I'll take a look to see whether I have any trades on. Alright, so how do I initiate the strategy? So as mentioned, I'm going to start off with the iron condor. So what I'm looking for is for this neutral reading. You can see I put a line in the middle down here. Now this is the stochastic oscillator down here, right? It comes with just the upper line and the lower line to tell you whether it's overbought or oversold. So this line you have to draw it yourself, right? You can just go onto the chart and just draw a line down here. So the first thing I'll look out for is to see whether it goes to this line. So as you can see down here, there's nothing I would do, right? I'll wait for it to go back up down here, which means to say the market has to probably go back up down here. So the moment it goes down here, then as you can see, it is in between the previous swing, right? This is the previous swing. You can see there's a resistance down here, and then there's support down here. So I know that when it comes back down here, I'm going to put an iron condor where the short strike is going to be above and below the previous swings, right? So this way I can place the iron condor. Now, I actually have a current position on. I have a position on somewhere around here when I place on the 29th of November. So you can see the market has gone up and then it came back down, and I think I placed it somewhere, maybe somewhere around here, right? Where it's close to this line. So what I did is that when it came to this line and it's somewhere around here, I placed my iron condor where the lower leg is somewhere here and the upper leg is somewhere above this previous swing high. Now I couldn't get this lower boundary to be below here because then I will get too little credit, but I had a more bullish view to this, so I thought of placing the boundary, the upper boundary, where it's above the previous high, this way that if the market does go up, at least it can come back down, right? So as you can see, at this point the market has gone down, but it has not breached, right, my strike down here. It has not breached my strike, so there's nothing for me to do. So basically this is how you initiate your iron condor. So let's say if you were to take a look down here, the place where you initiate the iron condor would be again somewhere here, right? The market comes down here, then you can see it's oversold down here. There's nothing you want to do. You want for it, wait for it to go back up, right? It went up and then you touch this line down here, right? Just nice. It's somewhere around 50, the reading. You can place an iron condor here. Then you can place the upper bound. Maybe the upper bound will be here, lower bound will be here, right? As you can see, is still somewhere in between down here. Now if you open up the charts and it's already passed down here, let's say it's somewhere down here, well then the next opportunity you will get is when the market comes back down here, right, at this point where it touches the 50, so it's probably this point down here, then you can initiate your iron condor. So you can see this is the previous high, this is the previous high, right? Ideally, if you can find one that is above the previous swing high, and then one that is below this previous swing low. So as you can see, a lot of time has already gone by. You'll be able to extract quite a good amount of extrinsic value already. Alright guys, so I'm going to go over to the trading platform to show you exactly what I mean. You can have a better understanding, and I'm going to show you my current position as well. By the way, if you found this video helpful so far, I'd appreciate if you give me a thumbs up as well as click the subscribe button. This way I can create more videos like this for you in the future. Alright, back to the video. Alright, so we are now at my trading platform, which is Think or Swim by TD Ameritrade. So basically you can see that I already have an iron condor position on at 197 and 168. I have 6 contracts on, so at the moment it's still pretty good, right? It's still in the middle. Alright, it's still in between this upper and lower boundary of this iron condor. So at this point in time, there's really nothing for me to do. Although the market right now is oversold, it has not touched 168, which is the short strike on the lower end of my iron condor. But what I'm looking to do is, the moment it touches this line, right, then I'm going to start looking for my bull put spread. Right, but if you are a little bit aggressive, what you could do is you could wait until it goes to 170, right, then you sell a bull put spread. Or if you want, you could go ahead and place, a trade right now, because legitimately it's already oversold, right? So this would also be a valid trade if you want to trade just a bull put spread. But ideally what you want is to ensure that you can find a short strike that is below the previous swing low. So as you can see, the previous swing low is around 162. So the place where you want to get your short strike at for your bull put spread, which is around 160. So let's simulate to see what kind of credit we can get. So as you can see, I've already got a position on this on the 20th January expiration date, at about 32 days left. So I'm going for somewhere around 30 to 60 days. 32 days is a little bit too short, because for me, what I like to do is I will take profit at 50%, and if it's less than 21 days and if it's a loss, I will generally cut it. So if I go for the 32 days expiration date, that means that only leaves me 11 days for the trade to work out, and that's a little bit too short of a time. I want slightly longer time. So in this case, you can see we have two other options. We have the 39 days and the 60 days. Now 60 days is okay, but it's a little bit too long for my liking, so we go for somewhere 39, which is the weekly option. Now because this is the index ETF, it's absolutely fine because it is very liquid. So as you can see, the bid-ask spread is very tight, right? It's pretty tight. So it's fine to use the weekly options. Now, if you go for individual stocks, you'll find that some of the spread will be very wide. So you do not want to go for that. So for this, so what we're going to look out for is we want to have a strike that is below 162.5, because if you remember, if we go to the chart again, you can see that the previous swing low is 162.5. So our short strike of our bull put spread has to be 160. So let's take a look at 160 to see what we can find. So 160 will be this. So what we want to do is we want to analyze a call vertical spread. Alright, so we want to see our call vertical spread. So as you can see, if we do a 5-point wide spread, what are we going to get? We're going to get $67 out of $500. Again, that is not worth it, right? If you could take a look at the risk profile, you can see you're only going to make 67, you're going to risk $433. So this is not going to work out in our favor. I will not go for that. So you most likely will not be able to go for this credit spread. If you want to have any credit at all, chances are you may want to go a little bit nearer to the market, maybe 165. So let me just simulate that. So you go for 165 and 160, you will get a higher credit for sure. But you want to see, is this the kind of risk you want to take? So it's about $1.10. Anywhere between $1 and $1.50 will be fine. But then again, you want to take a look at the chart to see where 165 is. As you can see, it's right at the support area. Well, this is okay if you think that the market is going to rebound. After that, you can go ahead and put that. But for me, I prefer for the market to go back down first. All right, then I will initiate my bull put spread. But in this case, you can see because I already have my iron condor on, that is why we want to always as much as possible initiate an iron condor trade first. So this way, anywhere the market goes in between, I'm just going to be collecting extrinsic value. As long as it does not breach this boundary, I don't do anything. And then once it reaches 50% profit, I'm going to just take it off. So the next thing I'm going to talk about is your trade management. So there are a few ways to manage these trades which you have. Again, I talk about them in detail in my previous videos. Just go to my channel and search for iron condor and credit spreads. But basically, the way I handle it is 50% of the credit I receive. So this I receive $1.62 per contract. So I'm looking to get out roughly around 80 cents, right? 80 cents. If it's 80 cents, I'm going to take it off for a profit. But then let's say, for example, if the market was to go all the way down, right, at this point in time, there's still 32 days left. I'm not going to do anything. I'm not going to close the trade. But if it's at 21 days, I will then take a look at where it is on the chart. Now, if at 21 days, if the market is below this short strike, I'm going to cut it for a loss, right? Regardless what it is, I'm just going to cut it for a loss, and then I'm going to wait until the condition is right again to put on the next trade. But if it's in between, right, this two short strikes, then I'm not going to do anything, because chances are I'm going to start to collect more extrinsic value, and then I may hit the 50% pretty soon. So that's what I'm planning to do. Now you're going to have a couple of trades on at the same time, because let's say, for example, at this point of time, let's say it's already past this short strike. Let's say, imagine this bar is somewhere around 165 today, and let's say today there's still 32 days left. I'll be initiating a credit spread, which is the bull put spread. So I have a bull put spread on, I also have the iron condor on, and I'm going to manage both of them separately. So the bull put spread, basically I'm also going to look for a 50% profit. So if it goes back up and then there's a profit on this, I'm going to close out the bull put spread, and I'm still going to leave the iron condor if the 50% is still not achieved yet, right? And the 21 days has not been reached yet. So this way, I'll have the bull put spread, profit, iron condor still holding on to it. Now, the other way that it could happen is if the market goes all the way down past our bull put spread as well. And in this case, the 21 days will reach first for the iron condor. So that means I'm going to close out the iron condor first for a loss, and I'm still going to hold on to the bull put spread, because the bull put spread, remember, we're going for a later expiration date. So because it's a later expiration date, we still have more days left before it's 21 days. So what I'm going to take a look at then is, at the point of time at 21 days for the bull put spread, is it a loss, or is it above my short strike, or is it inside my short strike? If it's inside my short strike, I'm going to just close it for a lot. But if it's above my short strike, I'm just going to hold on to it until I get a profit, or it breaches the short strike where I'm going to cut off the loss. So basically, that's how you're going to manage it. Now, the next thing that may be a little bit confusing is, what if the market goes down, all right, it goes back up, and then you already close your put spread for a profit, but your iron condor is still not 50%, and then the market goes down again. What do you do? Well, at this point of time, again, we want to follow the rules which we have earlier on, which is, if it breaches the short strike and it's still oversold, then we can look to sell another bull put spread then again. So it works for the same way on the top side as well for the bear call spread. So, alright guys, I hope that this has been clear for you. If it's not clear, please go ahead and ask any questions in the comments below. I'll answer your questions. And that's it for this video, guys. I hope this video has been helpful for you. If it has, please subscribe as well as click the like button. This way I can create more videos for you. And as always, may the options favor you.